If you have questions throughout, go to GarrettGunderson.com/WWGD, as in what would Garrett do? And we'll answer those questions here. I don't know when. We'll eventually get to them. But that's what we're here doing today. Got my buddy Chris from Life 180. What's up, man? This is from Brenda. She says, I want to take out a whole life policy. I actually have one from when I was younger. My dad started one at MetLife when I was a teenager. He turned it over to me years later. I'm 52 and still have it. But it's just a $25,000 policy. It's been helpful. I've used it twice for loans. But I am looking to take out a much larger policy on myself, my husband, and my 2 children. FYI, we have term life to cover us if anything happens. What type of companies do I want to look for? I thought I heard someone say on one of your shows, looking for mutual companies. I was looking at Northwestern Mutual, Penn Mutual, etc. The thing is, I don't know what I don't know. What I do want to ask the representative, I know is it supposed to be overfunded whole life, right? So let's just start there. We can go into more.
Yeah.
So, yeah, I mean, she's been listening and paying attention.
That's awesome.
So why mutual versus stock?
Well, not just mutual, participating mutual. And let me explain. Allstate is a mutual company. State Farm
I have a rule: company. Never buy a insurance policy with a PNC company.
Right.
Because even if it's a separate division, think about it. If they get in trouble because there's major hurricanes and it's a lot of PNC claims, like we had a huge winter in Utah, like there's a lot of claims there. What happens to the attention of that company?
Totally.
And the balance sheet of that company?
Nationwide is a mutual company.
It's on your side.
Nationwide has one of the top selling IUL products in the industry, right? Like, so just because it's mutual doesn't mean it's a participating mutual. So a participating mutual company means that you as the whole life policy holder are participating in the profitability of the company through a dividend.
Right.
That's what it is.
So I like companies that have always paid a dividend.
Sure.
Right.
What's not to like?
And for 100 years.
Yeah.
You know?
Yeah.
So that's a decent track record. It doesn't guarantee a dividend in the future, but once a dividend's paid,
it's locked in.
It's then locked in. It becomes guaranteed.
Yeah.
So participating mutual company. How many do you think there are out there? I always think of like a dozen that I would be comfortable holding a policy with.
I would say
maybe more.
I don't even know if I go that many, honestly.
All right, so let's see.
Ready to have some fun?
Yeah. We go with,
you do one, I'll do one.
She said Northwestern Mutual. Okay. I don't own a policy with them.
Okay, yeah, sure. New York Life.
Guardian.
Mass Mutual.
Penn Mutual.
Lafayette Life.
That's what I was going to say.
Gotcha.
Mutual Trust.
Mutual Trust. They
lower tier for you.
Yeah, lower tier, but still
I don't have one
on the spectrum.
One America.
One America. Oh, you got me. One America. That's 8. Security Mutual.
Yeah, don't know them.
Okay. Emeritus. Emeritus.
I've got one with them.
Yeah, you wouldn't do it again probably, but whatever. So that's 10. So 10 solid companies. We probably could stretch it out. Foresters, but they're not a mutual company. They're a
I've heard of them, but don't know their policy.
They're a fraternal company. They're not a mutual company. So I would stick to probably that 10.
Yeah, these are companies that have 100+ year track record.
Yeah,
they've got billions upon billions upon billions and some trillions.
Yeah,
trillion in assets.
Yeah, I mean a couple. They're monsters. Mass and Northwestern are just behemoths.
Yeah. I don't like that Northwestern punishes their agent when you borrow.
Yeah,
and that they kind of they try to be really captive and not allow their agents to look outside.
Northwestern's a fine company. I have just being honest, I have a problem with Northwestern Mutual's culture. The product is fine, but to me their culture is important. I want to work with
I would
people.
Never have someone replace one of those policies.
Of course not.
Right?
No,
cool.
No.
That's great.
I had somebody come to me the other day. It was they had a 9-year-old Northwestern Mutual policy, and they're and they watched one of my TikTok videos where I kind of said some not derogatory, but just things about Northwestern Mutual that I just believe to be true. And they were like, "Oh, I don't want to have this policy now because," and I'm like, "No, you can't replace that. That thing is still gold. At 9 years old, that's a great policy."
So the person who bought the largest whole life policy from Northwestern in the 80s,
okay,
they're sitting there, and they were looking to get a loan.
Yeah.
They're clients of mine, and I was like, I can have money to your house in 72 hours in a place you don't even know that it's there. And they're like, no way. I'm like, I promise you.
Yeah.
So we call the number because I have all their stuff. I'm like, call this number and just ask for, just say you're here with someone on the financial team and you have some questions. When they called and they saw the size of the policy, man, they put us up to, they were worried I was going to do something to replace it.
Yeah.
I wasn't. I was just, hey, we want to get a $500,000 loan. And I don't know anything about Northwestern, forms or or like,
Sure.
you know, what they're, so they ended up getting
Process.
that. And they're like, dude, that's awesome that we have that. They're
They
so
had
happy
no
that
idea what
have-
the asset
they didn't
they had.
realize like how easy it was to get access to the cash. They had
Yeah.
a ton of cash in there.
Yeah.
And so, yeah.
So,
And by the way, the Northwestern team was so jittery with me being
oh
on
yeah,
the
because they
line.
were nervous as all get out,
I
right?
was like,
why would you?
I'm praising you guys, not replacing
I
anything
know,
here.
but like, there's a lot of nefarious agents out there that would be commission hunting. I
haven't sat down and sold a life insurance policy since probably 06.
I got licensed again and I sell again, right? So it's been fun.
So
been fun.
I stayed licensed for a long time and went on app with Mike Isom when I was sending him leads and stuff like that, and starting an insurance agency now because it's like,
Yeah.
you know why.
I get it. I
Yeah.
get it. Yeah, no, I mean, it makes a lot of sense. So there's other things though. I think it's more important than just is it mutual or not.
Yeah.
Every company is a little bit different, and I think this is one of the things that is really important to understand. Not one company does everything well, right? And so when we look at what we're looking for in a policy, it's really a function of like, what are you looking for the policy to do for you? How, like, are you coming with the ability to front load a policy, the ability to front load a policy, like really over front load a policy, like 10 to 20x.
Some companies are going to be better than others.
100%. Some companies, when you want to do high levels of PUAs, the PUA charges.
That's the overcharge. That's the overpay. That's the paid up additions. Otherwise called overfunding is what she's referencing in here.
Yep. And so,
some charge more for that than
yeah.
others.
So I mean,
Some don't charge anything, right?
Well, some don't disclose what they charge, but they still charge. But like Lafayette and One America, 6%. Guardian, 11%.
Oh,
Penn
really?
Mutual, 15%. Right? Like, it is what it is. Penn Mutual, you have a lot of agents selling it. We're contract, like we, I don't do a lot of it because it's they charge a 15% PUA fee. They also pay higher commissions on PUAs to agents than any other company, right? So it's like you gotta just understand all these variables come in, but it's more than that. Above and beyond the cost of the PUAs, what are the flexibility of the paid up additions, right? Because one of the I guess ways that people rip on whole life is the lack of flexibility, which is not true. However, like certain companies, and I'm not going to call companies out on this one because I don't want to get in trouble, but like certain companies will, like, let's say you're doing a 70-30 split, like 70% paid up additions, 30% base, and a $10,000 premium. That means effectively 30%, $3,000 is going to the base, $7,000, 70% is going to paid up additions. Let's say 1 year or maybe like a 3-year period, you're not able to pay the $7,000 because times get tough, whatever, and you reduce it to pay the $3,000. A lot of companies are not going to allow you to start contributing the $7,000
Other companies
again.
say I need $100, right?
Yep.
$100 of paid up, and I'll let you keep doing it.
$120 fee or something like that. Yeah, and they do. But then even still, they'll reduce your ability to fund it completely, and there's a sliding scale that will reduce how much you're able to contribute. Some companies will, if you want and need that ultimate flexibility, there are some companies that are just better that will allow you ultimate flexibility and say, hey, no matter what you do, drop it, raise it, like up to the amount that you illustrated for, and you have that flexibility. And so, sometimes that flexibility carries more value for some people than others, right?
Mm-hmm.
Like, and so, for somebody that's like a W-2 employee that has, a ton of income and they know that they can pay it and they're using it for legacy and retirement, like volatility buffer planning and like legacy planning, they probably don't value that flexibility as much as if like you're a real estate investor or you're, an entrepreneur, right, and your cash flow is all over the map and, you need to have a year or two of flexibility.
Yeah, so she wants to know what to say to ask to get the product that she wants. So the first thing is, how much can be overfunded?
Yeah.
What's the max?
Yeah.
What's the flexibility?
Mm-hmm.
Right?
Yep.
Is it participating mutual company?
Yeah.
Would be the next question.
Yeah.
Everyone we listed have been around forever. So, there's a docket of companies. So it'd be great to have a policy out for the kids because it's going to be a lower premium, right? But I would say get the maximum amount on you, even if it's convertible term with whole life or whole life, depending on the cash flow.
And you can do term on yourself and then permanent on your kids. That's fine.
Right.
You don't need a whole life policy on you to get a whole life on your child.
Am I like I don't know, ideology. I'm saying you want to get it on the person that's making the most money first.
Of course.
And permanent would be great if possible.
Yeah.
Overfunded, even better.
Yeah.
And then get the kids after. But like securing the kids, health and death benefit, really critical.
Well, what's crazy is you can get a lot of insurance on your kids for very little amount of money. You can get, I think my daughter, I did a policy when she was like 2 months old or something, and it was like $300 a month, and it got her like $400,000 of death benefit,
Yeah.
and that's overfunded. You know what I mean? Like, and there's cash value accumulating, and
you don't have to overfund.
That's
Kids
insane.
don't have to be overfunded as
No,
much.
you don't.
It's kind of already built in.
You're kind of not able to overfund it the way you're able to overfund an adult policy.
Totally.
Yeah, there are restrictions because of MEC limits and term rider restrictions and all these things that go into it.
Yeah, and Brenda, you can go to cashflowbanking.gg and we'll make sure you get someone that can help you out with that.
Cool.
But anything else you'd mention there?
No, I think that's good.
2 short videos from Chris and Garrett. It's a near miracle.